All right, so let's start here.
Yes,
what's your take on the bond sell-off? Do you agree with the idea that it's hedge funds selling and that's what's leading to this bond sell-off, or are there other factors?
I think it's unclear, but I know one thing. Those that are selling are going to wish they did not, because we see the economy continuing to slow down with or without the tariffs. And we think that right now bond yields at 4+% are a bargain, especially for pension funds that are, of course, they finally have some yield in their fixed income. This is the place to be, U.S. Treasuries.
All right, so you think U.S. Treasuries are the place to be. We kind of teased you saying that you have a warning for Jay Powell and the Fed. What is that warning?
My warning is this. By the time you see the whites in the eyes, it's too late. The whole concept of being data dependent is too late. They should be cutting rates right now. It is clear that this is one of those events, and I've been around, I've seen the stock market crashes of the 80s, the dot-com, Lehman Brothers, COVID. This is another one of those things. They're going to call it the Trump trade wars. So this is the time to give confidence back into the market so things will settle down. They should cut rates now.
All right, you think they should cut rates now? So in your mind, I just want to be clear. So you think that would reduce yields, raise prices, it would make the bonds more attractive?
That's correct. But most importantly, what it would do is settle down world markets, all the fear and uncertainty that's out there. Because remember, the economy is already on a trajectory for much lower inflation and much weaker growth. That's already happening. We're already in a recession, whether it's real estate, whether it's commercial real estate, whether it's the home mortgage. This is the time to be cutting rates and to get ahead of the curve.
By the way, you can't see us behind you. We're just showing some of the previous Federal Reserve emergency rate cuts. They were very big events. It wasn't necessarily the actions of a president, but we don't want to get too jammed up with that right there. I want to go back to where you see opportunities in the bond market right now outside of treasuries. What about municipals? A lot of people talking about municipal bonds. Also, we've had a number of guests come on and talk about high-yield corporate bonds. What's your take on those two?
I would not be buying high-yield corporate bonds at all. In fact, if you look, corporate bonds are still rich. What do I mean by that? If you look at the beginning of the year, high-yield, the corporate bond high-yield index was out-yielding about 230, somewhere in that range, and the high grade somewhere around 80 basis points. We've now widened. High grade is now somewhere around 125. That's still below the average, the 30-year average.
Okay.
If you look at high yield, it's now somewhere around just over 4%. That's also still below the average. There's a lot more room to go for those spreads to widen and those areas to underperform.
All right, municipal bonds. Is that safety? Is that the safe place to go?
That's a good place to go. And they now are attractive. For a while there, they had been overvalued, whether it's taxable versus tax exempt or whether it's versus corporate bonds. But now they're very well valued. That's a good place to go, especially for individual investors.